If you've made massive profits on gold and silver through mutual funds or your exchange traded funds, ETFs that is, then don't just rush to book your profits as of yet, because you could end up paying a lot more tax than necessary. In fact, with the right strategy in place, you can legally reduce your tax outgo, even bring it down to almost zero. Let me tell you how. Well, first up, understand how do gold and silver profits and how are they really taxed. If you are investing in gold and silver via ETFs, that's exchange traded funds, then remember that holding on for more than 1 year qualifies as long-term capital gains, and therefore the tax rate in such a case is 12.5%. But if you are investing via fund of funds, the rule is that you need to hold for more than 2 years of your investments or profits to get the same tax rate of 12.5%. Anything shorter than that, 1 year, shorter than 1 year in ETFs, shorter than 2 years in fund of funds, you will have to pay taxes as per your income tax slab. So in case your income tax slab is high, 25, 30%, then you better look at gaining in the long-term capital gains. But here's the smart strategy and how some of the investors really play it differently. You need to ensure that you apply a powerful strategy here, which is called tax harvesting. You need to sell your gold or silver investments and then buy them at the same time as well back. So what has happened really here? Your portfolio stays the same, but your buying price now changes to much higher. Say for instance, you had bought gold for 1 lakh rupees, but today it is at 1.6 lakh rupees. So you sell your gold, but you immediately buy that gold for 1.6 lakh rupees or 1.61, whatever is the fluid price of ETF at that point in time. So what happens is that your portfolio of same gold quantity remains exactly the same, but your purchase price now becomes from 1 lakh to 1.6 lakh. So you save on the taxes of this 0.6 lakh rupees that you have earned in profits. So you sell in the future, whenever you sell in the future your gold or silver, your tax outgo will be much lower because the price will be calculated at 1.6 lakhs and not at 1 lakh. And that's called as tax harvesting. And you keep on doing that every year. And like this, you will be able to save a lot of your taxes. Remember, when in a year gold and silver prices have truly surged sharply in trade, and I've also seen sharp bounces and downturns as well, this strategy becomes even more powerful because now you can combine your gains and losses as well. There's another strategy. So in case you have made good profits on gold but you're sitting on losses, then also what you could do is, instead of ignoring the losses, use them to set off the gains and then save some taxes on the gains as well. So sell the silver on losses, sell the gold also on profits, but you will be ending up saving any kind of tax go on your profits because you're setting them off against the losses in silver. This directly reduces your taxable income as well. Now, if this truly works across the asset classes, equities, debt funds, and even other investments as well. There is more. If you have reported losses in the previous years, then you can carry them forward up to 8 years as well. So even old losses, you can help in saving your taxes in the future as well. And that's the important part. So tax harvesting is not just for profit makers. If you're sitting on losses, especially in silver after the recent fall from 4 lakh rupees to 2.5 lakh rupees, you can create a tax advantage there. So you sell, book the loss and re-enter just immediately or a little later. This loss can now be used to offset the gains, and especially useful if you have a short-term gain tax which is at a higher slab rate of your own income tax. But timing is everything here. Even if you do not have losses, you can still reduce your taxes by simply planning your exit. Instead of redeeming your entire investment at once, if you can split it across March and April as well, that means in 2 financial years within just a matter of 2 months, you can also say in the same lower tax bracket as well. So remember, with ETFs and mutual funds, you don't pay tax till the time you truly redeem. So what you do is, by holding on to your gains for a long period of time, you can control of when you will eventually pay taxes. But you do not treat this as a shortcut. You still need to consider rules like holding period and your overall investment strategy, because saving tax should not come at the cost of bad investment decisions. But here is the key takeaway. Tax harvesting truly helps you to lock in the profits, use the losses intelligently, reset your cost price, and reduce the future tax liability, all without changing your long-term bet on gold and silver. And in markets like these, it is not just about how much you earn, but it is also about how much you get to keep in your bank accounts.
If you like the video, do like, comment, share and subscribe.